Good morning. It's Thursday, the 9th of January, and this is Govindraj Ethiraj, headquartered in broadcasting and streaming as always from Mumbai, India's financial capital, which is, of course, a tad cooler than before. The top stories and themes. The stock markets fight back, a fresh bout of selling. Indians love gold but did not import as much as we thought last month as the government revises its figures. ONGC ties up with British Petroleum or BP to boost oil drilling output, the India Energy Week segment. Will India's new tax laws be simpler? And how security threats for APIs, which link almost all our financial transactions, are increasing.
This is the Core Report with Govindraj Ethiraj.
The markets fight back. The bulls fought hard on Wednesday, January 8th, but were not successful eventually. Nevertheless, the indices recovered after several swings, with the Bombay Stock Exchange Sensex pulling up 650 points from its day's low to settle at 78,141, down 58 points. To give you a sense of the swings, the Sensex traded in the range of 77,486 to 78,319 yesterday. The NSE Nifty50 closed down 19 points at 23,688. Amongst the broader markets, the Nifty Midcap100 was down about 1%, and so was the Nifty Smallcap100, which was down about 1.6%. So broadly, the Sensex has fallen almost 2,500 points or 3% in the last four trading sessions, which obviously indicates that the overall tenor of 2025 at start is still weak or muted, with no clear positive signals on the horizon. The only signal that lies ahead, of course, is more stress on the trade front as Donald Trump's presidency approaches, with the inauguration date set for January 20th. The domestic signals are, of course, the third quarter results of many companies, which will start streaming in now, and those may see some bright spots, but do not look like they will surprise, at least on the aggregate, on the upside as such. The other trigger, of course, going by tradition, is the union budget set to be presented on February 1st. While you could gear yourself for 10 on 10 stars from Indian industry or captains of Indian industry, regardless of what is said, told, or presented, the only thing that can really make a difference will be tax cuts, and most ideally personal income tax, which of course in the larger scheme of things seems unlikely given that the economy is slowing down and the government's capital expenditure levels have dropped. Nevertheless, that is one trigger. The income tax system could see some much needed overall, and that could help everyone, but not enough to fire up the markets. And more on that income tax changes shortly. Wall Street, meanwhile, was looking weak, and Tuesday saw some fairly high selling in the bond market, which is also the world's largest, on speculation that the Federal Reserve would not cut interest rates before July thanks to inflation risks. A sell-off in big tech also weighed heavily on Wall Street trading, with the S&P 500 down 1%, the Nasdaq 100 falling almost twice as much according to CNBC, adding that Nvidia sank about 6% on Tuesday. Treasuries fell across the curve, with a $39 billion sale of 10-year bonds drawing the highest yield since 2007. ONGC and BP join hands. And in our special energy segment, supported by the India Energy Week 2025, India's top oil exploration company, ONGC, or Oil and Natural Gas Corporation, on Wednesday said energy major BP will act as a technical service provider to help boost oil and gas output from India's largest producing field of India's west coast, also known as Bombay High. BP has promised an increase of up to 60% in production of oil and gas output from the Mumbai High field, discovered first in 1974, according to ONGC in a stock exchange filing reported by Reuters. The field reached a peak production level of 471,000 barrels per day of oil in March 85, and its output has now declined to about 134,000 barrels per day in April 2024, according to a tender document floated last year. India is also the world's third biggest oil importer and consumer and depends hugely on imported crude, that's more than 80%. Rising oil prices or a depreciating rupee obviously make all of this more expensive to import, as is the case right now. In June, the government had said that the ONGC was seeking a technical tie-up with the global oil major to boost production, and BP's board had met India's oil minister in September last year, according to Reuters. And as action picks up in the new year in the oil and energy space, I also reached out to Bjarne Schieldrop, Chief Commodity Analyst at Oslo headquartered SEB, and I began by asking him how he was seeing oil prices and oil price trends at this point.
The latest data we have on demand in China is December, right? And basically, the indications we got from China is actually quite weak. So they were building inventories. They imported more crude in November than the month before, 1.3 million barrels. At first sight, it looks very bullish that they import more, but most of that went into inventories because demand wasn't strong enough. And the reason why they imported more was because refineries got to borrow quotas for 2025 to import crude at lower prices in 24.
Right. Apart from the China factor, what are the other factors that are playing on oil prices right now?
That is the interesting thing. I think everyone had expectations of 2025 being a weak year, a challenging year for OPEC Plus, holding the price steady. But instead, we've seen actually the oil price rally into the new year, reaching $77, close to $78, with the 100, 200-day moving average at $79. So I think it has taken many by surprise. So what we see is that the crude market actually looks to be quite tight. Both in December, stronger than in November, and also into the new year. And part of that is probably due to the fact that Russia is exporting a very low amount of crude, or at 16-month low now at the start of the year, helping to tighten up the crude market. But we also have seen that the US crude inventories have fallen quite strongly, though product story is different.
Right. And one of the reasons, I guess, is the colder winter in Europe and North America. So when that stabilizes, could prices, ease off again? Or are there any other factors that are playing here?
Yes, I think definitely, colder weather helps to drive demand for heating oil. And as such, has helped to drive stronger gas oil cracks to some degree. But we still, when we look at developments in oil products, they're not all that strong. So I think it's more specifically on the crude side that we have this tightness into the new year rather than, but of course, additional demand for heating oil is helping the oil price and the oil complex.
Right. And how are you seeing oil prices into, let's say, February, March, or the second part of the first quarter?
The funny thing is that when you look at consumption through the year, we know that consumption in the first half of the year is maybe 1 million barrels per day softer than in the second half of the year. So usually much stronger demand than consumption in the second half. But still, historically, you see that prices are in general rising during the first half of the year and then declining in the second half of the year. So, the start of the year, this year, we see it follows that pattern exactly the same. But, that it's very, very early days for this year. But we are a strong believer that OPEC Plus will be able to control the market very nicely and keep prices steady. We do believe that there is a limited upside since OPEC Plus has so much spare capacity at hand, and they also do want to put part of those volumes back into the market.
And that could keep prices off. So last question, Bjorn. So war risk premium was a key theme in 2024. And how are you seeing it right now, given that we've seen some favorable developments in the Middle East, though other problems, including Russia, Ukraine, continue?
I haven't really been a strong believer in a big war premium on the oil through the second half of the year. But what is more important is Donald Trump becoming president in the US with promises of more sanctions towards Iran, harder sanctions towards Iran, most likely. And that could limit exports of crude out of Iran and help to stabilize the oil market, allow the rest of OPEC Plus to put more volumes into the market. So I think it's more that kind of elements rather than war disruptions being the key for supportive markets. But if you look at sort of prices for oil, we could easily move into $80 to $90 if we have continued strength in the crude market. If you just look at the backwardation we had in the Brent crude, VTI, and Dubai last year, it doesn't take much to drive it into $80 to $90.
Right, Bjorn. Thank you so much for joining me.
Thank you very much for having me.
And this segment was supported by India Energy Week 2025, scheduled for February 11th to 14th, 2025 in New Delhi. And you can register for the same using the link in the show notes below. India actually imported less gold. There was much shock and surprise when government figures had revealed last month that we had imported close to $15 billion of gold in the month of November, a record. Now, this figure obviously created some problems because it twisted the balance of payments numbers as well, since it appeared that we as a country were importing much more overall than before. And there was also speculation, including on the core report, about India's insatiable hunger for gold and what was driving it at that point. Turns out that those gold import numbers were wrong. So the government has now revised downwards the gold import data for November to $9.8 billion, which is obviously much lower than the earlier announced $14.8 billion, according to the Directorate General of Commercial Intelligence and Statistics, DGCIS data quoted by Business Standard. So that $5 billion revision was attributed to a calculation error caused by alleged double counting of gold shipments in warehouses following a change in methodology in July. So the report also adds that the Commerce Department, which oversees all of this, has not issued any official statement on the revised data. Now, since imports are lower, India's trade deficit also fell to $32.8 billion from the previously reported all-time high of $37.8 billion. So staying with gold, India is the world's second largest consumer and imports heavily to meet most demand, which typically increases during the festival and wedding season in the October, November, December quarter. Despite the revision of November numbers, according to Reuters, the country, that's India, spent a record $47 billion on gold imports in the first 11 months of 2024, surpassing the $42.6 billion spent in the whole of 2023. Now, all of this happened even as gold prices jumped to a record high during the year. And also remember, gold has returned close to 26% in 2024, being obviously one of the best performing asset classes. New tax laws are coming. The government has promised to simplify income tax filing rules to make it less tedious for taxpayers to comply with the law and help cut down on disputes that have gone past $120 billion over the past decade, according to Reuters, which also added that a proposed revamp of that income tax of 1961 is now being finalized and is set to be issued for public consultation in mid-January, which is presumably a week or week and a half away. The government and the finance ministry had started inviting suggestions for the revamp of that union budget of 2024 in July last year, and the core report too has been showcasing several viewpoints from well-known tax experts. The revised legislation could be released in the government's budget, which is expected early February or February 1st. Changes involve simplifying the language and rationalizing information by using formulas and tables. Reuters also says the proposed changes could include complex income computation structures to be replaced by formulas, a single definition of tax year to replace the current practice of assessment year and financial year, tabular depiction for identical taxpayers for easier understanding, and reducing the number of additional forms taxpayers need to submit with their tax returns and making them available online. All of this is, of course, most welcome, and like always, we will wait to see what actually and finally emerges before we can comment further. The API attack. You've quite likely heard of API, or Application Programming Interface, which is basically a set of rules and protocols that allows applications, which is software, to communicate with each other. It is APIs which could allow you to buy a railway ticket or an Indigo or Air India airline ticket on, let's say, on a platform like Make My Trip, or do a unified payment interface or UPI transaction from a Google Pay app, which obviously passes through the NPCI and then goes to your bank, or an e-commerce transaction, which links your bank account or credit card to the e-commerce player who's sitting outside. So APIs are more prevalent in our lives than we think and are thus also the gateway to cyber attacks of all kinds, intensifying in the age of artificial intelligence. Recent data via Seattle headquartered cloud security company F5 Network suggests that 92% of all mitigated attacks in the past year were API related, up from 70%. So when software creates, it also tries to cure. Obviously, to understand the scale of API linked security problems and how organizations and individuals should be thinking or responding to it, I reached out to Pratik Shah, Managing Director for India and SAARC at F5 Networks, and began by asking him to define why API-linked attacks are a matter of concern right now.
Let's look at the economy that we are living into, right? It's an API economy. API are no longer just the technical interface. It's actually the language of innovation. It is also how organizations are building partnership, scaling their ambitions, and in turn, creating an entirely new industry. Like, you would have seen so many new startups building a particular use case and completely digital, completely API first architecture that they have, right? So if you see, for modern businesses, APIs are the new architectures. And in 2025, they will APIs will further determine whether the digital economy will thrive or crumble, right? Because if you look into the nature of APIs, by default, the nature of APIs is very much revolutionary, but it's also what it makes them more vulnerable. The reason it becomes much more vulnerable is they open doors. They open doors to interact. They open doors to share and create something which is, it could be a new industry, new use case, etc. That also means it's an opportunity for bad actors to exploit those kind of open doors, right? And it's also just not about cyber attacks, it's also about the erosion of the trust that is fundamental to the digital business as such. And we have seen so many breaches in the recent times, especially API related breach. Almost, we have seen 3000% increase in API attacks over last, 2 quarters. And in fact, more than 85 to 90% of the traffic revolves around API traffic. So that's how critical the nature of API, traffic is in the modern, API economy.
So when we talk about this interconnect of APIs across, let's say, businesses or the way we use or we transact, what are the biggest examples or the most prominent examples where, let's say, there are two sets of systems talking to each other through APIs and therefore why they are so vulnerable?
As you would have seen, if you look into the state where most of the businesses are, it's truly hybrid in nature. The organizations have kind of repatriated their workloads from public cloud to a different environment because of many issues. It could be complexity, data sovereignty, or it could be even the cost pressures as such, right? If you see this workloads or the data for this particular workloads is still fragmented. It could be on cloud, it could be on the edge, or it could be on premise, etc. An API acts as a single glue to connect this, fragmented data systems, right? It is very, very important that APIs are secure enough to serve as a foundational for everything that that requires, like for example, AI workflows or the real-time data exchanges and things like that.
So, what would be the most prominent, let's say, area or let's say business where you think the API or the chances of API failure are high today?
And if you look into some of the recent attacks that have happened in the financial services space, or for that matter, even healthcare, right? By nature of the dynamic business environments, they expose APIs. Their business revolves around, exchanging APIs with third party, with supply chain vendors, with partners across the industry. For that matter, even travel and insurance could be a big vertical where they expose those kind of APIs for parties to exchange data and share and create something which is valuable, right? So some of the industries, answering your question, financial services, including insurance, definitely pretty big. And even healthcare and pharma industry is also pretty big when it comes to the API exchanges.
And what are companies like yours doing now to try and protect this? And where do you start? I mean, because I'm assuming these APIs sit on systems that are already running in these large companies, which are also protected maybe by other cybersecurity solutions. So where do you come in, and or rather, how do you come in?
All right. So I'll talk about the traditional defenses first, and then come to specifically what FI does. The traditional defenses, when we talk about the defenses like network firewalls or cloud security solutions or WAFs, in general, are able to provide some kind of defense when it comes to application or network level of attacks. Okay. And then, there are modern businesses which also deploys API gateways, which allows them to authenticate, rate limit the API exchange and as such, right? But the biggest problem that is seen is around the shadow APIs, about the undocumented APIs, about the vulnerabilities in the APIs, which creates a whole new dark spot, right? And hence it's important that there are tools available. There should be some kind of tools that allows them to look into the API holistically in terms of, starting with API discovery. It also is important to have a continuous vulnerability testing of all of these APIs, because an unsecured API is as good as a big dark spot in the environment. If you look into the cyber kill chain, right, there's multiple steps of cyber kill chain. But an access to an unsecured API could be a killer shot for the bad actor. It can also lead to data exploitation. It could lead to some kind of data theft. It could lead to lot many other consequences because of the unsecured APIs. Company like FI is with a mission to protect each and every API wherever they are. And that's the mission that we have been completely focused into, irrespective of workloads being on a public cloud, on the microservices, or at the edge. And with the advent of AI, as you know, AI has been a revolutionary technology, and a lot of AI workloads will actually work on the fundamental of APIs. Right? Most of these are microservices architecture. APIs is the real medium to communicate. I believe that FI is placed extremely well in this hybrid state where we can protect each and every APIs irrespective of where they are.
Right. And you've talked about how, of course, in this interconnected world of business where people share, and I'm assuming when you talk about travel or hospitality, we can see that. I mean, I go to let's say a website, I'm booking a room in another, hotel chain, and therefore someone has opened an API for this aggregator to enter that and so on. So that's clearly how the world is going. Is there something that could change, or is there any other sort of mega trend that you're seeing in, let's say, in the coming year or so, which people need to be either careful about or welcome or worried about, whichever way you look at it?
Let's talk about AI and the kind of, implications of AI. Like I mentioned, lot many cybersecurity vendors are powering their cybersecurity solutions through AI, which we call it as AI-powered cybersecurity solutions. It's equally important to understand that the excess of AIs is also with the bad actors, right? They can leverage those kind of tools available to create sophisticated payloads that can have a meaningful impact. The shift has to happen in the mindset from defense to offense. All this while the conversation around cybersecurity was often focused on risk avoidance. In the API economy that we all are living, API security plays a very competitive advantage. Like you give an example of a travel or an aggregator for that matter, right? It allows them to create something which opens up the opportunity to innovate and scale. There are so many companies formed on the journey of innovation and on the journey of scale only because they have a secure API framework, because they are an API first company, right? So it also gives partners and users like us to have greater confidence to collaborate and to work with them. It also allows to build the ecosystems that the economy depends upon.
Right. Pratik, thank you so much for joining me.
Likewise, my pleasure to talk to you.
That was the core report with me, Govindraj Ethiraj. Do stay connected with more of our coverage at the core. You can check out our website or sign up to our newsletter for our exclusive stories, one in-depth feature a day on www.thecore.in. Do also track us on LinkedIn, where we usually post synopses or extracts of our top stories and interviews. We would love your feedback on how we can make business more interesting and relevant, including, of course, India's vibrant manufacturing sector. So write to us at feedback@thecore.in, and thank you once again for listening.